Hi there, just a quick video to answer a few questions that we had on our recent note about stock buybacks in the US. We had three types of questions that I'll try to answer. The first was what might change in the future with regard to the buybacks, and I'll start with that. Matt Levine wrote about our article in his Money Stuff blog, and he pointed out that, you know, if you just think about these private companies, OpenAI, SpaceX, Thrive, Anthropic, that there's private companies out there worth a couple $1 trillion that eventually are likely to come to the public markets, and that will be an offset to all of the buybacks that are going on, although not sure how many years of buybacks that would cover. The second thing is that as the stock market continues to grind higher and higher, the cost of equity capital is going down, and we're not too far away from a place where companies should be noticing that the cost of equity capital is pretty close to the cost of issuing senior investment grade debt. And so maybe we'll start to see some amount of stock issuance from some companies to buy back their debt, or just stock issuance at a low cost of equity capital. I think a few things that are probably going to take longer or are less likely is that the flow into 401k and IRA plans, you know, might start to reverse as the population of savers gets older and starts to draw down their savings. Another one is that we might get more investors looking at expected returns and making their asset allocation decisions. You know, I think that was a big theme of the note, was talking about how different kinds of asset allocation approaches really can exacerbate the impact of these buybacks. And to the extent that people focus more on expected returns in doing their asset allocation in a positive way, that will really help. Although I was talking to one friend who pointed out that, I don't know, like 10, 15 years ago, the Norwegian oil fund, which has about $2 trillion of assets, revisited their expected return for equities and reduced the expected return, but then they increased their allocation to equities. So it really has to be people kind of moving their allocations in the direction that makes sense with changes in expected returns, not what the Norwegian oil fund did, which is sometimes called reaching for yield, which is a kind of return chasing. And I guess the final thing that could happen is that we get some sort of change to the taxes where buybacks are taxed more heavily than just 1%, which would be more neutral for the U.S. Treasury in any case. The second questions that we got were just around corporate incentives and stock options. And you know, we pointed out that the way that executive stock options work, it really incentivizes the buybacks. Yeah, I mean, this is kind of a problem. I'm not sure how it's going to get changed, but the you know, having stock option grants as incentives for executives does lead to some poor incentives. I mean, for one thing, companies will often have will have a very high stated return on equity, you know, where they won't do projects that are still positive but don't have a super high return, because they really want to get the highest stock price, not get the highest amount of net present value creation for shareholders. Anyway, that's a much bigger topic. And finally, you know, people asked, how long can this go on for? You know, that, or how long can the combination of static asset allocators and return chasers and so on, you know, where the impact of that kind of approach to asset allocation is allowing these buybacks and return of capital to drive equities higher and higher and higher and increase the price earnings ratio. And, you know, to the extent that we think that maybe buybacks are moving prices up by 3 to 5% a year more than they would otherwise go up by on average, as we noted in our paper, well, it could go on for a long time. It takes 15 years. You know, in 15 years, the multiple of the U.S. stock market would double from around 40 right now, or 35 to 40 right now, to 70 or 80. So, you know, we've seen that kind of PE in other markets in Japan in the late 80s. And so, you know, this could really run a very long time, although probably as valuations continue to go up and earnings yield and the cost of capital down, you know, we'll probably start to see new equity issuance in a pretty big way at some point, as we did around 2000, 2001. All right, that's all the questions we got. Please keep the questions coming on old papers, new papers, everything. We are happy to get them, and helps us to think about things that are of interest to you. So thanks a lot. Signing off. Bye-bye.